In January 2026, gold reached an all-time high. By May, that historic rally had collapsed, shedding 25% of its value in a matter of weeks. Under normal circumstances, an asset known as an inflation hedge would surge during a period of rising prices. And in May 2026, the U.S. Consumer Price Index spiked to a multi-year high of 4.2%. This dual-axis chart plots the divergence. As headline inflation accelerated to 4.2%, the spot price of gold did the exact opposite, plummeting to $4,165 an ounce. Silver absorbed the same shock with greater leverage, wiping out 22% of its value in a 30-day window. The textbook logic treating precious metals purely as a defense against consumer inflation mathematically failed investors here. To understand what actually triggered the sell-off, we have to look beneath the headline inflation rate. The global flow of institutional capital into and out of commodities responds to forces in the bond market. Government bond yields, rather than the cost of consumer goods, govern the true valuation of gold and silver. The baseline for these yields, and the ultimate competitor to precious metals, is the debt issued by the United States Treasury. To decode the precise mechanics of the Q2 market crash, we have to calculate the explicit financial cost of holding metals instead of holding government debt. Forecasting the price of gold requires an accurate read on the mechanical logic of the U.S. Treasury market. In macroeconomic terms, opportunity cost is the explicit financial penalty you pay for holding an asset that produces no income. Physical gold has a distinct structural limitation. No matter its price appreciation, a gold bar sitting in a vault generates exactly 0.00% in cash flow. That zero yield competes directly against the 10-year U.S. Treasury bond, an asset that pays a guaranteed, sovereign-backed return. We visualize this competition on a scale. During the metal sell-off, the nominal yield on that 10-year Treasury sat at an elevated 4.45%. Faced with this disparity, institutional money logically abandons a zero-yield asset to capture a high, guaranteed payout from the government. This capital migration accelerates rapidly whenever investors anticipate the central bank maintaining a restrictive monetary policy. The risk-free rate of return offered by the U.S. government dictates the movement of liquidity, making it gold's primary financial adversary. Relying solely on that 4.45% nominal yield gives an incomplete picture. Nominal rates ignore the eroding purchasing power caused by inflation. Analysts evaluate precious metals using a specific equation. Nominal yield minus inflation expectations equals real yield. Nominal yield is the bond's stated rate. Inflation expectations represent forecasted price increases. Subtracting them reveals the real yield, the actual net return an investor takes home. This specific calculated metric acts as the primary gravitational force, controlling the value of gold. The market rule is highly precise. Gold only functions effectively as a hedge when this equation outputs a negative number. In May 2026, a severe disruption in global energy supply chains sent oil prices surging. This energy shock pushed headline inflation artificially high, driven by the cost of fuel rather than organic underlying economic growth. Instead of buying gold to protect against those rising prices, bond traders priced in aggressive Federal Reserve rate hikes to combat the energy inflation. This CME FedWatch gauge mapped a 72% likelihood of impending rate hikes. Because of this, nominal yields were forced up significantly faster than long-term inflation expectations. Real yields spiked violently into positive territory, creating a catastrophic setup for non-yielding assets. The Q2 gold crash represents a perfectly rational mathematical response to a positive shock in real yields, rather than a failure of the asset's utility. This yield dynamic also explains why silver dropped twice as fast as gold, pushing the gold-to-silver price ratio to an elevated 63.9. Silver operates as a high beta asset, reacting with exaggerated, leveraged volatility to broader market shocks. The first driver of this extreme volatility is the massive disparity in economic scale and liquidity between the two metals. This chart compares annual mining value. Gold produces roughly $436 billion in output. Silver yields a mere $60 billion. Because silver's liquidity pool is so much smaller, even minor institutional capital outflows trigger violent, disproportionate price swings. The second factor driving this volatility is silver's complex demand profile. It acts simultaneously as a monetary asset and an industrial input. Rising interest rates restrict borrowing, threatening the economic expansion that fuels vital silver-heavy sectors like renewable energy and electronics. Silver suffered unique devastation during the 2026 rate shock due to a simultaneous attack on its monetary appeal and its industrial utility. When we pull back from the May 2026 anomaly, this mechanism holds true across a multi-year macroeconomic timeframe. This chart plots the 10-year real yield, inverted here for visual clarity, directly against the gold spot price. The visual evidence is clear. The two assets move in a near-perfect inverse correlation. Every sharp spike in real yields perfectly aligns with a severe drop in gold. The data confirms a consistent rule. Opportunity cost dictates asset pricing. Tracking headline consumer inflation remains an analytical trap. The only reliable leading indicator for precious metals is the trajectory of real bond yields. There is, however, a critical structural nuance that prevented gold from collapsing even further in 2026. Despite intense headwinds in the bond market, a massive wave of institutional buying absorbed the retail sell-off. Sovereign central banks accumulated gold at a record pace, purchasing 244 net tons in the first quarter of 2026 alone. These institutions acquire gold to harden their long-term systemic architecture against geopolitical risk, ignoring short-term fluctuations in real yields. The mathematics of real yields will continuously dictate the medium-term volatility of precious metals, but this ongoing wave of sovereign accumulation has structurally raised the absolute floor of the global market.